Today we'll cover the chapter of asset of stock, how to account for stock in our financial statements and in our T accounts. So, as stock, as we have seen, is an asset. Stock is anything which is purchased by a business to resell at a higher price to in order to make a profit. Businesses generally aimed to run to make a profit, hence stock is generally the main item which is used as a means to that profit. Now, the following objectives we would cover through our chapters, which you can see here. Now, uh, because stock movements, they are not they are not a very typical asset to record in T accounts, so that's why the movement of the stock is not recorded in the T accounts as it would be recorded for any other assets such as cash, fixed assets, or van. The issue with this is because stock is bought at a lower price and sold at a higher price to make a profit. Hence, to record that prices, because the purchase would be at a lower price and the sale would be at a higher price, so this would not give a true indication of the total amount of stock left. That's why we use a trading and profit and loss account to find out how much the stock we have left and what is the resultant profit. So we just suffice to say here that stock movements are not uh, the, the the recording of stock is not covered as we would record other sort of assets. So now we would discuss more in detail. So what is a stock? For example, if a company is buying toys to resale at a profit. So the stock that it would have would be stock of toys. So the toys that it would purchase would be stock, which would be sold at a higher price to make profit. So there would be, so we'll find two ways of what makes the stock of goods increase. One would be purchase of additional goods, and the other would be the return of goods which were previously sold by the business, which the customers returned either due to maybe a change in their choice, or because there was a defect in the product. So the purchase of goods, there would be two aspects when you purchase goods. One would be the purchases account would be debited, and the other in which it's a return, it would be the return inwards account which would be affected. So if there is an increase in stock, there would be two accounts uh, that could be generally hit, which would be a purchases account, and the second one would be a returns inward account. If we look at ways of how stock can decrease, it could either be because we have sold out goods, or because the purchases that we had made previously, we returned it back to the supplier because maybe it was damaged, or maybe because we no longer wanted it if we were allowed to return it. So in decreases in stock, the two accounts that would be related would be a sales account, which would be to record sales of goods, and a returned outward account, which would be used to record goods that we have returned to the supplier. So basically, in terms of stock, these are the four accounts that we would need to know: purchases account, sales account, return inwards account, and return outwards account. So now we will go through an example of purchase of stock and how we would record it in terms of the double entry bookkeeping. So on 1st August, goods costing 165 are bought on credit from D. Henry. So if we stop here, we would first consider the two accounts or the two effects this transaction would have. One is the purchases of goods, and the other one, because it's credit, so it's a creditor which would be hit, which would be affected. So once we find out which accounts we think are going to be affected, we would then make create T accounts. So one would be purchases and the other would be D Henry, which is a creditor account. So purchases. Now purchases, because it's an increase in purchase, which is purchases leads to an increase in asset. So even though purchases is not an asset account, but here because purchases means an increase in stock and stock is an asset, any increase in purchases would be debited. So we would debit a purchase account. And as we bought the goods on credit from D. Henry is a creditor. So an increase in creditor would be would mean that we would credit the account. So we debited purchases account by 165 and then we credited D Henry account by 165. Please make note that the account headings, dates, and the subheadings in the account are correct. Now, if on the other hand we were to buy the same goods for cash, we know one entry would be purchases, and but on the other side the credit would be cash because we've paid cash to make the purchases. So cash is an asset account, and if the cash decreases, it would be credited. So purchases on credit and purchases on cash are very similar. It's just the other corresponding credit entry, which would either be in the creditor account or in the cash account. We've covered the purchases. Now we'll move on to sale of stock on credit. Now sale means sale of stock. The sale account, the sales account is not a creditor account, but we would take it as a decrease in stock. So decrease in stock means stock is an asset. So a decrease in asset means we would credit account. That's how we would treat sales. So sales is a decrease in asset stock. So we would always credit the sales account here. So we would credit the sales account and then we would debit J. Lee, who is our debtor. So I'll say we'll again go through this entry. So if there is a sale of goods on credit, we will figure out the true effects of the transaction. One would be the sales, the other would be either an increase in cash if it's a cash account, or it would be an increase in the debtor account. What is a debtor? A debtor is a person whom we made a sale to but who has not given us money as of yet. So that is debtor is a as is an asset account. So we would debit the asset account, which is the debtor. So in this case, it's Jaylee. We would debit Jaylee's account by 375, and we would credit the sales account because sales means there is a reduction in stock, which means a decrease in asset. So hence that's why we will credit the sales account here. If on the other hand the same sale was on cash, if so there was goods are sold for £55, we would again, we will just hold back and consider the two effects. If there is a sale of goods on for cash, we definitely know that there is an increase in cash. On the other hand, there would be an increase in sales or a reduction in stock. So the first entry would be debit cash because cash has increased, which is an asset account. So the cash account would be debited by 55. On the other hand, stock is reduced. Stock is reduced, but we will not reduce because stock is an asset. We would account for it in the sales account by crediting it because we'll credit it because the stock has decreased. So we will credit the sales account by 55. So we have covered the two more important accounts that affect stock, which was the purchases and the sales. So purchases account is always debited because it increases stock, and sales account is always credited because it decreases the stock. Now we'll move to two other accounts which affect the stock account, which are not very common, but again they have an effect of either increasing or reducing the stock. So the first one would be return inwards. Now, as the word says, return inwards, it means goods that are coming inside our business. Return inwards. This means so our customers who we had made sales to, they are returning back the goods. Now there could be very various different reasons why somebody would return goods, and the points here highlighted in orange are the reasons that are given. So we sent goods of the wrong size, the wrong color, or the wrong model. It could be because of a mistake in the order, or the goods may have been damaged in transit, or the third would be the goods are of poor quality. So now these three examples you should kind of like at least have it in your mind or remember because it might come in either an MCQ in paper 1, or it could be like a very small 2 mark or 3 mark